another session with an awesome speaker. This speaker is Mr. Jesus Rodriguez. He is a technology expert, serial entrepreneur, angel investor, an internationally recognized speaker and author. A computer scientist by background, Jesus is the CEO of IntoTheBlock. I love the title. A platform that leverages advanced machine learning to understand and predict crypto asset markets. Jesus is also the chief scientist and managing partner at IntoTheBlock, a development studio focused on leveraging deep technology trends such as artificial intelligence or blockchain technologies in real-world applications. Jesus has been the recipient of several industry awards, including the Inc. 500. He serves as a board member in several enterprise software companies and is an investor in over a dozen startups. Welcome, Jesus. We look forward to your presentation. Enjoy.
Thank you very much, Lavinia. Happy to be here, and thank you everybody for joining us. Today we're going to be talking about high-frequency trading and decentralized finance. So we have a lot of ground to cover. A little bit about myself. Lavinia did a little bit of an intro. I'm the CEO of IntoTheBlock. So we work at the intersection of machine learning and crypto. I have had a career in tech that includes 10 years at Microsoft and Wall Street building quant systems, a couple of exits as an entrepreneur, very active investor in both machine learning and crypto. Teach at Columbia University as a guest lecturer, published what I would say is a decently popular machine learning newsletter at The Sequence. And every day I get the opportunity of applying machine learning techniques to crypto assets as part of the work that we do in IntoTheBlock. So we leverage data science to extrapolate insights about crypto assets. Our analytics platform has over 170 clients, including some of the most prominent banks in crypto. We also have, we work on quantitative trading strategies that we execute with some of the top crypto asset managers in the space. Here I cannot disclose a whole lot, but our strategies process hundreds of millions of dollars in DeFi trades regularly, and a lot of the ideas that we apply in high-frequency trading is what we're going to discuss in this section. The agenda for today is very, very simple. So I'm going to talk about HFT from a decentralized finance perspective. Then we're going to spend a few minutes talking about some of the key building blocks of building high-frequency trading strategies in DeFi. And I would like to leave you at the very end with some, let's say, more futuristic ideas about DeFi and HFT. As I said, at any given point, feel free to use the Q&A panel, and I will stop for questions. So DeFi and high-frequency trading. High-frequency trading has been always about speed. Since the very beginning, it's a discipline from the 1970s, became popular in the mid-2000s, but the idea of leveraging the speed and information has been around forever. One of the famous examples is Nathan Rothschild during the Battle of Waterloo. He was able to obtain news about the victory of the Duke of Wellington ahead of the time that the news reached the London Stock Exchange. So there were rumors that Napoleon was winning the battle and the bonds of the British government collapsed. The Rothschild family was able to buy those bonds and then sell them when the news finally arrived that the British has won the Battle of Waterloo. As markets became electronic, high-frequency trading became a common discipline, but it was very obscure. Not many people knew about it. It was highly popularized with the Michael Lewis book Flashpoint that sort of shed light into the industry and the practices. And fun enough, this book came out just weeks before the first HFT company, Virtu Financial, was scheduled to go public. And the backslash of the book was so strong that they need to postpone the IPO. So in HFT, in traditional market, there are many types of strategies. There are traditional strategies that arbitrage inefficiencies of indices that are mispriced. There are strategies that take advantage of events like news or M&As or things like that. There are strategies that just do arbitrage based on statistics across different venues. There are things that are just based on trying to front run a specific order. So is there is different type of HFT strategies, but they're all based on speed. So one of the bad things about HFT is that the innovation in terms of technology and technique hasn't been there. It's been mostly about being faster than anyone else. But you still need to deal with intermediaries. So you still need to deal with market makers. You still need to deal with centralized exchanges and things like that. So decentralized finance introduces some new dimensions to the way that we traditionally think about high frequency trading. In general, if there is one takeaway that I want you to learn from this session, is that DeFi HFT is not about speed anymore. There are other factors that add some different vectors that you should evaluate when you think about high frequency trading and DeFi. For instance, there are factors related to the block time at which transactions can be processed, the fact that everything is visible on the blockchain, the fact that transactions have a cost, the role of miners, as well as the risk that you're taking on the protocol side. Let's break down one by one each one of these factors. So, for instance, traditional HFT has always been about speed, but in crypto, you're subject to the speed miners can produce block. So in the Ethereum blockchain, that's every few seconds. So it doesn't matter how fast you can execute a trade. You always have that delay. So speed is not that much of a factor anymore because you cannot be faster than the block producing time, which sort of introduces a new type of strategies that you need to think about it. Also, HFT have been traditionally obscure. If you're trading with HFT strategies in traditional market, you for the most part you don't see what anybody else is doing. Nobody else can see what you're doing. But in crypto, in DeFi, everything is transparent. Everything is public on blockchain ledgers. So that introduces a different dynamic. So how would HFT work in a world in which you can see what your competition is doing and your competition can see every single trade that you're doing? So the game dynamics are very different. There is also a factor of cost. So for the most part, if you're trading HFT with HFT mechanisms in traditional markets, you know what your cost is. It's infrastructure. You pay some fees to exchanges, but it's very predictable. In DeFi, you have the cost of transactions. So you have gas fees and things like that vary according to market conditions, according to network usage. So it's something that you need to evaluate because you can execute perfectly viable trades, but then the cost of execution in the form of gas, Ethereum blockchain could be too expensive, and then the trades become invaluable. Then there is this new concept of miner extractable value that ultimately you're at the mercy of the order in which miners place transactions in a given block. There is some mining companies, arguably unethical, are some of the biggest front runners of DeFi trades in the market, and that's why projects like Flashbot, like ArcherDAO, are trying to mitigate that with providing mechanisms by which you can compensate miners based on the transaction that they're processing, and based on that compensation, based on this incentive, they can place the transactions in a block accordingly. Because if not, you can have again a perfect trade, but then the miner places it in the front order, or they front run the transaction, and then the trade becomes unviable. So the way that you should think about a comparison between traditional finance and DeFi when it comes to HFT, given an opportunity in traditional HFT, you have different algorithms that they try to be faster than anybody else, and they execute it solely based on speed. But when it comes to DeFi, you have other factors, right? You have block time, you have cost, you have MEV, you have the transparency, gaming dynamics, you have many other things that you need to evaluate in order to formulate correct HFT strategy. So a very simple comparison between traditional HFT and DeFi HFT. In traditional HFT, the information is sort of imperfect. So you don't see what your competition is doing. Your competition doesn't see what you're doing. In DeFi HFT is a perfect information game. You can see all the trades. If you want to front run a transaction, you can. Some other people are going to try to front run your transaction. The cost in traditional market for HFT strategies is nearly fixed, whether in DeFi HFT is completely variable. The speed of execution is measured in nanoseconds. Here it is in DeFi is limited by block time. And for the most part, the traditional infrastructure in HFT, in traditional HFT is very well known. Whether in DeFi, you're always vulnerable to the minor criteria for placing transactions on a given block. So infrastructure, a second takeaway from this session. The first one is that DeFi HFT is not about speed anymore. The second takeaway is that infrastructure in DeFi HFT always beats strategy. So infrastructure is key. Having a good infrastructure to execute trades, to discover strategies, to monitor mempools, to analyze the cost of execution, things like that. In the long run, it's better to have a great trading strategies. So when you're thinking about DeFi HFT, a lot of these concepts are intuitive, but there are really not many people implementing this type of solution at a scale. And so there is not a whole lot of documentation or best practices or things that you can follow. So I would like to show you some of the best practices that we have learned the hard way from doing this stuff. So some of the key building blocks that you need to use when thinking about HFT strategies in DeFi. One of them is monitoring mempools. It's very intuitive, right? So many transactions, many strategies are based on identifying, let's say, imbalances in automatic market makers or misprice or arbitrage opportunities with DeFi indices, and you can monitor those in mempools before the transactions get processed and try to forecast the state of the blockchain, right? The state of a specific AMM after that transaction gets mined. So having good mechanisms for monitoring mempool is essential to DeFi HFT strategies. Also, the idea of every transaction in DeFi costs money. So in the case of Ethereum, strategies that execute in Ethereum DeFi protocols, we're talking about gas. Gas gets expensive or cheaper throughout the day. So having mechanisms to accumulate gas when it's cheap, to spend it in bidding wars when it's more expensive is key. We typically use fee tokens, that is the tokenized mechanism for gas, and typically we use heuristic algorithms to estimate when the cost gas is cheaper. As you can see with this heat map on a specific hours during the day, purchase it these days and use it in bidding trades when it's more expensive. Then the idea that you can, when you place a transaction in DeFi HFT protocols, you need to look out for front runners. It's always going to happen. So their bots are the only thing that they're looking for is trying to front run a specific transaction. If you're trading passively in Uniswap or Balancer and all that, you're getting front run for the most part. So having a good mechanism to monitor the mempool, identify front runners, and then try to enter in a bidding war and try to bid out those transactions is important. For the most part, once you bid multiple times, front runners get out of the way and you can execute. Then the idea that you can to avoid this concept of front running mechanism, what I mentioned, there are projects like Flashbot, like Archer DAO, that are providing integration with mining pools directly. So you can essentially assign a price to the transaction, how much are you willing to pay, and the miners will use that. So Flashbots in particular have getting a lot of attention recently. So being able to integrate with this type of protocols to route directly to mining pools is sort of an interesting idea, a good building block to have in DeFi HFT strategies. Then there is also the idea of obfuscating the input of transactions. If front runners are going to be trying to understand what you're doing and trying to front run the transactions, you can sort of obfuscate the input, so it takes a little bit harder, much of an effort to understand, to try to understand what your trade is trying to do. And then on that note, even if transactions are obfuscated, you can use this mechanism of replaying the transactions of chain. So there are clients like Open Ethereum that allow you to do that. You can replay the transactions of chain, forecast the state of the blockchain a few milliseconds before the transaction gets processed, understand how the blockchain is going to look like, and proceed to do a trade. So there are other relevant building blocks of DeFi HFT strategies. So things like understanding maybe price prediction models based on signals on centralized exchanges, integration with multiple protocols is key. There's some emerging set of strategies that are arbitraging between different blockchains and things like that, like Ethereum and Polygon is a very common type of arbitrage these days. So there are some interesting ideas in that sense, but the building blocks that I mentioned are probably some of the key. So I would like to show you like 2 or 3 basic strategies, so you get an idea how does HFT in DeFi looks like. So for instance, an interesting strategy that we have put in place and have been relatively successful is this idea of arbitraging AMM balances. So think about transactions in protocols like Uniswap or Balancer that can cause an imbalance in a pool. Typically, there are bots that will try to arbitrage that transaction in that pool, but what is even more interesting is that if you can arbitrage across many AMMs. So a traditional strategy here is you monitor the mempool, you identify transactions that could cause an arbitrage, you calculate the best path of executing across Uniswap, Balancer, SushiSwap, and others to maximize that profit, place a transaction, then you need to monitor the mempool for front runners that will try and start in that bidding war and ultimately try to process to get your transaction executed. This works very well with UniB2, with Balancer, with SushiSwap. With protocols like UniB3, then liquidity mining has moved from being a passive mechanism to an active market making mechanism. So there are strategies in UniB3 for HFT in which you're supplying liquidity literally block by block. So you can look at the mempool, identify where those transactions are going to land, and try to provide liquidity within those ranges in Uniswap V3, and do that every block. So you can be moving literally hundreds of millions every single block, which is a very interesting type of HFT strategy. Another type of strategies that we have seen being very successful is arbitraging DeFi indices. This is a classic one. In traditional markets, there are many strategies that arbitrage ETF or indices mispriced. In DeFi, indices are very inefficient. So you can monitor mempool. I see some transactions that will cause an index like DeFi Pulse and others to be mispriced, and buy and sell on both ends. So buying an AMM and sell the index, or the other way around. And it's a strategy that, for the most part, works. It takes a little bit of work, but there are many variations of it that have been quite successful. So to close out, and I know I'm going like 1,000 miles per hour, but to close out, I would like to leave you with 2 futuristic ideas about the future of HFT and DeFi. One of them, and I published an article in CoinDesk about this thesis, is this idea of automatic strategy learning. So today we're designing strategies one by one, but there are techniques such as reinforcement learning and things like that in machine learning that, if you, given the state of the blockchain, it can learn from every single trade and formulate trades on the fly. This is quite interesting. Another idea that we're very intrigued by is this concept of tokenized HFT strategies. So today we have protocols like Y-Earn, like Convex, that are tokenizing passive strategies, so supplying liquidity and things like that. So why not tokenize active strategies and place trades block by block? And you can put money into a pool, receive a token, and that protocol will actually trade different HFT strategies and return the profits in the form of tokens. So quick summary, and I know I went really fast, but I really wanted to provide all this content as part of this session. DeFi represents a new playground for HFT. It's the first technology movement that sort of challenges the fundamentals of HFT. Infrastructure is key to execute HFT strategies in DeFi, and HFT is the feature, not a bug in DeFi. Right? Many protocols like Uniswap, like Balancer, include arbitrage as a key building blocks. So it's part of the infrastructure. So as DeFi continues to evolve, HFT is going to continue to evolve in DeFi for the foreseeable future. That's all I wanted to cover. I would like to thank you very much. You can contact me directly at jr@IntoTheBlock.com or through my Medium blog. I tend to be very active on Medium and I'm relatively responsive via email. Perfect. Well, thank you very much for having me, and I hope you enjoy the content.
Thank you so much, Jesus.